So imagine you are standing in the middle of a beautiful, sun-drenched retirement community in California.
It sounds nice.
Right. You're looking at two homes sitting side by side, and they are completely identical. I
Okay.
mean, they share the exact same walls, the same meticulously maintained landscaping, the same community pool, and, the same quiet neighborhood streets.
Yeah.
Yet, when the owners of these two identical homes eventually go to sell, their financial realities are going to be like worlds apart. One neighbor is going to walk away with a comfortable retirement fund, easily transitioning into their next phase of life.
And the other?
The other neighbor is completely trapped in a financial void, like totally unable to access the equity they thought they were building for decades.
Wow.
And the craziest part about this whole scenario, this massive life-altering wealth gap, all comes down to a tiny $19 difference in monthly expenses.
Yeah, I mean, when you look at it on a human level, it really does defy logic. You assume identical homes in the same neighborhood hold the same value. But what we were really looking at today is the mathematical reality of how affordable housing structures actually function on the back end, long after the ribbon-cutting ceremony.
Welcome to today's deep dive, where we are going to untangle exactly how that happens. Our mission today is to look at a highly specific, absolutely fascinating document.
It really is fascinating.
It's a June 2026 comprehensive draft analysis, and it's titled 2026 Housing Authority Limits, Budgetary Impacts, and Seller Equity.
Quite a mouthful.
Yeah, it was prepared by Daniel Steele, who's the treasurer for the Watercolors at La Quinta Senior Housing Community. We're going to explore how a complex web of statutory formulas in California can take something as mundane as a tiny $19 increase in homeowner association dues and inadvertently just destroy the life savings of vulnerable senior citizens.
And, while our source today is intensely focused on this one specific senior community in La Quinta, the implications are massive for anyone interested in economics, real estate, or local governance.
Oh, absolutely.
This analysis serves as a masterclass in the unintended consequences of well-meaning laws. It perfectly illustrates what happens when incredibly rigid legislation collides with the unpredictable realities of everyday inflation.
So before we can even begin to understand how a $19 fee breaks this entire system, we really need to understand the rules of this specific financial ecosystem.
Right.
The Treasurer's report points immediately to the California Health and Safety Code, specifically Section 500502.5, which dictates that we are dealing with a deed-restricted community with two distinct tiers of buyers.
Right, the low-income and moderate-income tiers.
Exactly. But let's pause right there for a second. What does deed-restricted actually mean for you if you own one of these homes?
That is the foundation of this entire issue. A deed restriction is essentially a legal lock placed on the property's title.
Okay.
It dictates exactly who can buy the home, and critically, it limits how much they can pay for it.
So it's not just a suggestion.
No, not at all. In this community, that restriction lasts for 45 years. It's a binding legal covenant designed to keep the home permanently affordable, regardless of what the open free market is doing outside the community gates.
Okay, so the state imposes these two tiers, low income and moderate income.
Mm-hmm.
But the report highlights something that completely baffled me. Both of these tiers are anchored to the exact same baseline metric.
Yeah, the median income.
Right. For a two-person household in 2026, the local median income is set at $85,200. Why use the exact same starting line if the state intends to treat these two groups completely differently?
Well, it's an administrative anchor. Lawmakers use one regional number to define the economic health of an area, but the divergence happens in how the state applies friction to that number.
Friction, okay.
Yeah. Let's look at a low-income buyer. Their actual household income cannot exceed $78,750. But the state doesn't look at their actual income to determine what they can afford.
Wait, they don't?
No. The statutory formula dictates they are only legally allowed to spend 30% of 70% of that $85,200 median number on housing.
I swear I had to read that formula 3 times in the source. 30% of 70% of the median.
It's convoluted, yeah.
When you finally crunch that math, you arrive at a strict absolute monthly housing cap of $1,491.
Keep that number at the front of your mind. $4,491 is the absolute ceiling.
Got it.
Now, look at how the exact same state law treats the moderate income tier. The state allows those buyers to anchor to 110% of that same median income, and they are allowed to spend 35% of it on housing.
So they get a bigger piece of the pie.
Exactly. That creates a monthly cap of $2,734.
This is where I really struggle with the logic here. It's like two people are given the exact same $85,200 pie, but the government steps in and says the low-income buyer is legally only allowed to eat a tiny sliver, while the moderate-income buyer is permitted to eat almost half the pie.
Yeah, that's a good way to look at it.
The moderate-income buyer suddenly has 183% more purchasing power, even though everything is supposedly based on the exact same median income metric. I mean, why create such a massive gap right out of the gate?
Well, you have to look at the historical intent behind the statute. The lawmakers who wrote this code were trying to be hyper-protective.
Protective of the low-income buyer.
Right. They designed that compounding restrictive formula to ensure that a low-income buyer is never, ever over-leveraged.
Okay.
The goal is to mandate a massive financial safety buffer, so a low-income household isn't crushed by a mortgage if they face, say, an unexpected medical bill or a job loss.
I mean, that sounds incredibly noble in theory.
In theory, yes.
Yeah.
But by artificially suppressing exactly how much of their own money they are legally allowed to spend on housing, the state inadvertently sets the stage for a severe structural wealth disparity later on.
Oh, I see.
The ceiling meant to protect the incoming buyer becomes the exact same ceiling that eventually crushes the outgoing seller.
Which brings us to the operational realities of actually running a neighborhood. Let's introduce the trigger for this whole crisis, the $19 domino effect.
Right.
You mentioned that $4,491 monthly spending limit is an absolute ceiling.
It is an unyielding brick wall. Not one penny can exceed it. And that $491 has to cover absolutely every aspect of homeownership.
Everything.
Everything. The mortgage principal, the interest, property taxes, insurance, a state-mandated utility allowance, and critically for this report, the monthly homeowner association dues.
So we look at the Treasurer's report for the upcoming 2027 budget. The Community Board is proposing a tiny increase in those HOA dues. They just want to raise the fee from $316 a month to $335 a month.
Just 19 bucks.
Right. If you own a regular home, you might complain to your spouse about an extra $19, but you adjust your budget, maybe skip a few coffees, and you move on.
But in this deed-restricted ecosystem, the incoming low-income buyer is not legally permitted to adjust their budget.
Because of the wall.
Exactly. Their housing budget is locked by state law at $1,491. So if the HOA column in the monthly ledger goes up by $19, the math dictates that another column must go down by $19.
And what goes down?
The only column with any flexibility at all, the principal and interest on the mortgage.
Hold on. I need to get this straight because this just feels backward to me.
Sure.
If I sell a car and the buyer finds out their insurance rates went up, that's the buyer's problem. They pay the difference. Are you saying that if the community needs 19 extra bucks a month to cover landscaping or rising pool maintenance costs, the buyer doesn't pay for it?
The buyer cannot pay for it. The state law forbids it.
Wow.
If their total monthly outlay exceeds $1,491, the sale is illegal and cannot proceed.
Yeah.
So the bank looks at the new, higher HOA fee and says, well, we have $19 less to work with every month for the mortgage payment.
Okay, following.
And a smaller monthly mortgage payment means the bank can only approve a smaller total loan. And a smaller loan means the seller gets less money for their house.
So the seller pays for the community's inflation by taking a hit on the sale price of their own home.
Precisely.
That is wild. The Treasurer's report actually proves this by unleveraging the mortgage backward. And it introduces another concept we really need to clarify, the silent second loan.
Right. This is a vital piece of the puzzle. To make these homes affordable in the first place, the housing authority uses what's called a silent second deferred loan.
Wait, a silent second? Like a second mortgage?
Yeah, essentially. It is basically a subsidy in this case, around $103,000 that the government provides to help the buyer make the purchase. It sits quietly behind the primary mortgage.
Oh, okay, so the buyer doesn't pay monthly on it?
Right. The buyer doesn't make monthly payments on it, but it deeply affects the total allowable financing limit of the home when we run the affordability math.
Okay, so the Treasurer takes all these variables. He looks at the current prevailing interest rate of 6.71%, factors in a standard 20% down payment, includes that $103,000 silent second loan, and accounts for 1.5% in property taxes and insurance.
A lot of math.
Yeah, a lot. And when he runs that massive algebraic formula using the old $316 HOA dues, he finds the maximum allowable resale price of the home is $275,080.
But then he runs the exact same calculation, changing absolutely nothing except swapping in the new $335 HOA dues.
And because that extra $19 a month eats into the amount of mortgage principal the incoming buyer can finance, the home's maximum permissible resale price drops to $272,119.
Yeah.
A $19 monthly fee hike just vaporized almost $3,000 of the seller's net worth.
Yeah.
I mean, how does anyone justify operational inflation eating the homeowner's equity like that?
It feels deeply unfair, almost punitive. But the mathematical reality is that the state's formula doesn't care about the seller's equity.
It just ignores it.
Completely. The legislation is entirely blind to the seller. It only cares about maintaining that protective $1,491 barrier for the next person moving in.
Wow.
The system fundamentally demands that the departing senior citizen absorb the entirety of the community's inflation over time.
And this $19 domino effect doesn't just happen in a vacuum.
Yeah.
The treasurer introduces a concept he calls the fixed cost squeeze, and it shows how this situation rapidly devolves into a financial vice grip. Let's talk about those fixed costs.
Yeah, costs like HOA dues, the state's fixed $75 utility allowance, property taxes, and insurance. These are flat fees. The landscaper doesn't charge less to mow the lawn of a low-income home versus a moderate-income home.
Right, the grass is the same.
Exactly. The costs are identical.
So if you are that moderate income buyer, armed with your $2,734 monthly allowance, that new $335 half HOA fee only takes up about 12% of your housing budget.
Very manageable.
Right. But if you are the low-income buyer restricted to the $1,491 limit, that exact same $335 fee suddenly consumes a massive 22.5% of your total allowance.
It's huge.
The fixed costs just completely devour the pie.
And that is before you even introduce the most volatile, uncontrollable variable of all, interest rates.
Oh man, interest rates.
Yeah. The treasurer included an interest rate sensitivity matrix in this draft analysis that is genuinely alarming. We've been using the 6.71% current interest rate for our baseline, but he models what happens if prevailing macroeconomic rates jump up to 7.50%.
If rates jump to 7.5%, the bank's cost of lending goes up. So to keep that new buyer's monthly payment under the absolute $1,491 cap with the new $335 HOA dues, the maximum listing price of the home has to plummet down to $260,476.
Think about the broader implications of that. The core American promise of homeownership is that you buy a property, pay down the debt, and over time you build equity.
That's the dream, yeah.
But in this specific low-income tier, home valuations literally stagnate or actively decline when operational costs or interest rates rise.
That's terrifying.
A senior citizen who bought their unit years ago when interest rates were around 3.5% might find themselves in a situation where they legally have to sell their home for less than they originally paid for it, simply because today's interest rates are higher and the community raised the HOA dues a few bucks.
Let's try to visualize this mechanism for a second. It's like you are trying to pack for a trip, but your suitcase is physically incapable of expanding.
Okay, I like this.
The fixed costs and the interest rates are these incredibly bulky winter coats, and you keep having to stuff more of them into the bag. The actual value of the home, the seller's hard-earned equity, is a pair of socks.
Right.
Because the rigid walls of the suitcase cannot budge, every time you shove a new bulky coat inside, it forces the socks completely out of the bag.
That is an excellent way to conceptualize it.
Let's
The total volume of the suitcase is locked by state law, so the uncontrollable outside forces just continually squeeze the seller's equity completely out of the equation.
We really need to transition from the cold, hard math of that suitcase to the devastating human consequences. And I want to really focus on this because we are talking about a 55 and older retirement community.
Yes, that's crucial.
What actually happens when these senior citizens reach an age or a health status where they need to sell and transition to end-of-life care?
This is where the treasurer's analysis exposes a profound systemic tragedy. Remember that 45-year deed restriction we discussed earlier?
Yeah, the lock on the title.
Right. That means if you are a low-income seller, you are legally obligated to sell only to a new low-income buyer. You are totally locked out of the open, unrestricted real estate market.
So that shrinking suitcase, that $4,491 limit of the next buyer coming in, becomes an absolute unbreakable ceiling on your current life savings.
Precisely. And the staggering reality documented in this report is that a low-income seller could yield up to $193,000 less in sale proceeds than their moderate-income neighbor who is selling the exact same physical unit with the same floor plan.
Let me stop you there because that number is just, it's hard to process. We have two people who have lived next door to each other for 20 years.
Right.
They swam in the same pool, drove on the same streets, but purely because of an initial deed designation from decades ago. One senior gets to walk away with normal generational wealth, and the other is financially gutted. I mean, how does a policy designed to help vulnerable people create a trap like that?
It breaks the traditional housing continuum. The standard model assumes a sequence of events, right? You buy a home, the property appreciates, and in your twilight years, you sell it.
Right, the nest egg.
Exactly. That built-up equity is the specific financial tool you use to fund your transition into a private assisted living facility, or it gives you the capital to relocate closer to your family for care.
But because this low-income equity is artificially capped by the state formula and then basically eroded from the inside out by rising HOA dues and interest rates, these seniors are left with almost zero liquid capital when they finally sell. The equity they thought was their safety net simply doesn't exist.
But it leaves them entirely trapped. They lack the hundreds of thousands of dollars required to buy into private assisted living. They are financially barred from relocating on their own terms. The mathematical reality of the back end of this affordable housing model is that it strips the lowest income residents of their financial independence at the exact moment they need upward mobility the most.
And the tragic downstream effect of that is they're forced to become entirely reliant on state aid and heavily subsidized care facilities. A system that was explicitly designed to give them a leg up actually forces them into permanent dependence on the state.
It creates a massive artificial wealth gap between neighbors who lived identical lifestyles, all stemming from rigid legislative math that refuse to account for inflation.
So with this financial trap so clearly and devastatingly defined by the treasurer, what options does the community board actually have? I mean, they still have to keep the lights on. They have to pay the landscaping vendors. How do they stop their own residents from falling into this trap?
The treasurer's recommendations are urgent, and they require a total paradigm shift in how an HOA board thinks about governance. They have to wake up and realize they are operating in a hard-capped financial ecosystem. There is zero revenue elasticity.
Because, as we've established, trying to pass the cost onto the consumer literally destroys the consumer's net worth.
Right.
So the treasurer's first recommendation is to freeze or strictly minimize any dues adjustments at that $316 baseline. He explicitly warns the board that routine annual increases or special assessments, which are standard practice in normal neighborhoods, are a high-risk strategy here.
If this board operates like a typical HOA and just hikes fees whenever they need a quick cash infusion for a project, they will rapidly and artificially depress the property values of their own low-income members.
And that leads to a whole new set of problems.
Oh, absolutely. The danger there is that it eventually triggers widespread mortgage delinquencies when those seniors realize their homes are financially underwater and they simply walk away.
His second recommendation is to conduct what he calls affordability stress testing. Basically, before the board even thinks about signing off on any future operational decisions, they have to proactively run the math against those strict $1,491 and $2,734 limits.
Yes.
They have to mathematically prove to themselves they aren't accidentally pricing future buyers out of the mortgage market.
And the third recommendation is perhaps the most difficult but crucial for day-to-day survival optimized vendor operations. The board is directed to audit every single recurring contract.
Like landscaping and pool maintenance?
Exactly. Landscaping, maintenance, general utilities. They can't just accept a vendor's annual price hike anymore.
They have to find cost-neutral efficiencies. Think about your own neighborhood or even your local government, and how often organizations solve their budget problems simply by raising prices or raising taxes.
It's the standard move.
It is the path of least resistance. But this report proves that in highly regulated environments, taking that easy way out and just raising fees actually cannibalizes the community from the inside out.
It is a phenomenal lesson in forced fiscal discipline. When the law mathematically prevents management from passing costs onto the members without destroying their life savings, management is forced to actually manage.
Right.
They have to roll up their sleeves, rigorously renegotiate contracts, and find true operational efficiencies because taking the lazy route of hiking the dues will ruin their neighbors.
To recap the journey we've just been on, we looked at how a strict California statutory formula, which was genuinely meant to keep housing affordable and protect buyers, essentially weaponizes a simple $19 HOA increase.
Right.
Because of an unyielding monthly cap, that $19 fee translates into a nearly $3,000 equity loss for the seller. Over time, that fixed cost squeeze traps low-income seniors, prevents them from accessing the open market, blocks them from affording private assisted living, and ultimately creates a staggering $193,000 wealth gap between next-door neighbors living in identical homes.
And as we wrap up this analysis, I want to leave you with one final implication derived directly from the math in this report.
Okay, let's hear it.
It is frankly chilling. We've spent this whole time talking about variables the community board can theoretically control, like HOA dues, but that rigid statutory formula also makes fixed assumptions about massive macroeconomic forces outside anyone's control.
Like what?
It allows a fixed $75 utility allowance, and it assumes property taxes and home insurance will hover around 1.5%.
Right, but anyone paying attention to the news knows those numbers are not stable.
Exactly. Look at the world around us. What happens in a near future where climate change causes California home insurance premiums to double overnight? Or instability in the energy grid causes local utility bills to triple?
Wow.
If that $1,491.91 monthly cap remains an unyielding, unbreakable state law, and those massive, uncontrollable outside inflationary forces consume that entire number, does the maximum allowable price of these seniors' homes eventually drop below zero?
Wow. A scenario where you legally cannot sell your own home because the fixed outside costs exceed the state-mandated affordability cap. The home essentially becomes a liability you can't give away.
It's a scary thought.
It really is. Thank you so much for joining us on this deep dive. We hope this empowers you to look a little closer at the hidden math governing your own communities, the unintended consequences of well-meaning regulations, and the long-term impact of administrative quick fixes. Because as we've seen today, sometimes two identical homes sharing the same walls and the same streets are actually existing in completely different financial universes.